Welcome everyone to The Explainer. Today, we are going to completely unpack the black box of credit card processing fees and trace exactly where your money goes when you swipe. It's something we all do almost every single day, right? Yet the invisible financial plumbing operating behind the scenes is just incredibly complex. So let's break the whole shebang down.
Okay, let's dive right into this fundamental question. When you top your card for a $100 purchase, why does the merchant only actually see about 97 bucks? Now you might be thinking, hey, that's just a tiny haircut, but for businesses running on razor-thin margins, that roughly 3% represents a massive chunk of their potential profit. To really understand why card acceptance costs are just stubbornly high, we've got to look at the mechanics of the transaction itself.
So, here is our roadmap for today. We'll start with the four-party card model, then slice up the anatomy of a swipe fee, do some decoding of processor pricing models, explore global rules and network moats, and wrap up with the future of payments.
To really grasp the stakes here, we have to recognize a mind-blowing number. Visa and Mastercard combined handled over $23 trillion in global card spending in 2025 alone. Just to put that into perspective, Visa processed $14 trillion across 258 billion individual transactions, and Mastercard handled another $9.2 trillion. The sheer, massive scale of this ecosystem is breathtaking. And remember, every single one of those billions of transactions carries a fee.
All right, let's jump into Section 1, the four-party card model.
So this is literally a chain reaction. You, the cardholder, swipe at the merchant, the acquirer routes it to the network, and the issuing bank ultimately approves it. Now, it's kind of funny the industry calls it a four-party model because there are actually 5 distinct entities here passing data and risk back and forth in a matter of milliseconds.
Here is absolutely crucial context. Visa and Mastercard, they don't actually issue cards, and they don't extend credit themselves. They just provide the switching infrastructure and set the rules of the game. It's a huge misconception. Your card might have a big Visa logo on it, but the actual credit risk is held by your issuing bank, like Chase or Capital One. The network just sits in the middle, essentially collecting a toll for keeping the rails running.
Which leads us perfectly into Section 2, Anatomy of a Swipe Fee.
Every single time a card is tapped, the merchant gets hit with a combined fee called the merchant discount rate. An easy way to remember how this breaks down is the handy acronym MAI. M is for markup, which goes straight to the processor. A is for assessments, which go to the card networks, and I is for interchange, which goes back to the issuing bank. All 3 of those are bundled together to create the true cost of your swipe.
But look at how completely lopsided this pie is. On a typical $100 purchase carrying a $2.50 fee, the issuing bank gobbles up the vast majority with a $1.75 interchange fee. We're talking 70 to 80% of the total cost, just boom, gone to the issuer. This interchange fee is strictly non-negotiable, and honestly, it's exactly what funds those super lucrative cashback and travel reward points that consumers absolutely love, leaving much smaller slices for the processor and the network.
Moving right along to Section 3, decoding processor pricing models.
When you contrast your processor options, you really see the trade-offs. Flat or blended models offer super easy simplicity for startups, paying 2.9% plus 30 cents no matter what. It makes budgeting a breeze. But if a customer pays with a cheap debit card, the processor just pockets the difference. On the flip side, the Interchange Plus Plus model provides the ultimate transparency for larger merchants. It passes through the exact base costs and adds a defined markup, so businesses can truly see exactly who makes what and optimize their margins.
But wait, merchants also have to constantly battle what we call hidden fee creep and junk fees. We're talking penalties for swiping instead of using a chip, or brand new network assessments that just silently eat away at profit margins. The networks are always diversifying their revenue. Visa recently rolled out a digital commerce service fee and, get this, starting in 2026, an integrity risk fee specifically for crypto transactions. They might look like tiny fractions of a percent, but across billions of swipes, it adds up to a massive burden.
Let's step back a bit for Section 4, Global Rules and Network Moats.
So, zooming out from the individual swipe, massive global regulations completely dictate these costs. Take the US, for example. Credit cards generate huge unregulated interchange revenue, which funds all those rewards. But the Durbin Amendment came in and strictly capped debit interchange, which literally changed banking economics overnight. Debit interchange was basically cut in half for large issuers, so banks naturally doubled down on marketing credit cards to push consumers toward those higher interchange, unregulated products.
And wow, does geography matter immensely here. The contrast is actually amazing. U.S. merchants suffer some of the absolutely highest fees in the world just to subsidize those generous consumer rewards. Meanwhile, EU merchants enjoy heavily capped, super predictable fees, but with way fewer consumer perks. In Europe, they capped credit card interchange at 0.3%. That means a $100 purchase in Germany might cost the merchant a mere 30 cents in interchange, compared to well over $2 for the exact same purchase here in the US.
Now, despite all the merchant complaints and the mounting pressure to lower costs, Visa and Mastercard maintain their total dominance. Why? Because they provide profound value and security that both consumers and businesses completely rely on. It isn't just a fee for moving money. You're paying a fee for trust. Guaranteed settlement means the merchant gets paid even if the consumer completely defaults on their credit card bill. And chargeback rights give us all the confidence to buy things online knowing we're protected against fraud.
Finally, let's look ahead with Section 5, the future of payments. When you look at the margins of businesses like grocery stores, which are scraping by on just a 1 to 2% profit margin, you really have to ask, what does the future look like? Well, we're seeing the rise of alternative rails, like stablecoins on networks such as Spark. These offer a peer-to-peer architecture that strips out all those intermediaries and slashes that 2 to 3% fee down to basically zero. It's a direct transfer on a shared ledger, no issuer, no acquirer, no scheme fee. For a business processing $1 million in volume, that's tens of thousands of dollars in real annual savings right back in their pocket.
However, to remain totally objective here, we have to acknowledge what stablecoins are currently lacking. They don't natively offer credit, they definitely lack universal consumer adoption, and transactions are final by default, without any network-level dispute resolution. When a transaction is final on the blockchain, hey, the merchant loves it, but the consumer? They instantly lose that critical safety net of being able to easily reverse a fraudulent charge. And this right here brilliantly illustrates the ultimate trade-off that merchants and builders are facing today, the cost of acceptance versus the profound value of a trusted, secure ecosystem. The technology for cheaper payments, it's literally already here. But displacing established consumer behavior and the massive network moats of Visa and Mastercard, that is an incredibly steep hill to climb.
So I'm going to leave you with this final thought to chew on for your own business. How long is it actually going to take for zero-fee alternative rails to build up the fraud protection and consumer trust required to finally dethrone the multi-trillion-dollar four-party model? As the payments landscape keeps evolving at breakneck speed, staying informed on these underlying economics is absolutely vital to protecting your bottom line. Thanks so much for joining me for this explainer, and keep asking the right questions.